Good afternoon. Today, the most valuable company in the world changed hands. Apple retook the crown from Nvidia, closing near $4.9 trillion, capping the ugliest week for chip stocks since last year's tariff shock. And almost everyone read it the same way. The artificial intelligence bubble finally popped. But look at what actually happened underneath. The single most important company in the whole artificial intelligence supply chain, Taiwan Semiconductor, posted a record quarter and raised its guidance and got sold anyway. That is not a demand crack. It's a handoff, and understanding the difference is most of today's brief. Let's get into it. Here's the board. Stocks fell on the chip rout. The S&P closed down about 0.5%, near 7,533. The Nasdaq down 1.5% as semiconductors led the losses. The Dow down 0.2%, holding up better on a rotation into defensive staples. The headline of the day sits in the corner. Apple retook the title of most valuable company from Nvidia, near $4.9 trillion. As Nvidia fell about 3.5%, now watch the cross-currents. The 10-year Treasury yield backed up toward 4.6%, a near two-month high, but on oil, not growth, after fresh United States strikes on Iran pushed Brent near $85. And here's the tell inside the tell. Gold slipped below $4,000 an ounce, even with a live war headline. That only makes sense if the market is reading this oil move as inflationary. A firmer dollar and higher rates, not as a reason to run for safety. Bitcoin is quiet near 63,000. Hold that gold detail, it comes back. Now the signature segment, consensus versus the read. First, and this is today's deep dive. The crowd's instant verdict on the crown changing hands was simple. Chips crashed, Apple beat Nvidia, the artificial intelligence trade is over, sell it. But test that against what the companies actually said. Taiwan Semiconductor did not miss. It raised its guidance, and it raised its capital spending to between $60 and $64 billion. The market didn't sell demand. It sold the trade-off between certainty and optionality, and Apple did not retake the crown by winning artificial intelligence. It retook it by spending the least on it, capital returns instead of capital expenditure. At the exact moment the market got nervous about who has to pay for the whole build-out. A crossover driven by peak spending anxiety is a sentiment signal, not a verdict on whether the technology is real. High conviction. And Frankie takes the whole thing apart in today's focus. Second read, the most shared market take today came from Gavin Baker, who runs Attrades Management. His line, lots of cheap stocks with durable advantages that are going to crush numbers for the next 6 to 12 quarters. The rotation he's describing is real, but here's the asymmetry the crowd is missing. The big technology artificial intelligence monetizers, Alphabet, Amazon, Meta, and Microsoft, have already lagged this year. Those four added only about $426 billion of market value combined in 2026, and Microsoft is actually down about 18%, while the picks and shovels suppliers led. In other words, the artificial intelligence trade everyone is now dumping is not even the trade that worked. And the monetizers report earnings next week. Selling them into that print, to crowd into consumer staples, is the crowded move, not the contrarian one. Medium-high conviction. Third read, the lazy assumption on a risk-off day is that everything risky gets sold, including crypto. The money says the opposite. In the very same week the tape de-risked artificial intelligence, Citadel Securities put $400 million into the exchange Crypto.com at a $20 billion valuation. That's Crypto.com's first institutional round, and it mirrors Citadel's $200 million bet on Kraken last November. Add Visa building stablecoin rails and the depository trust company going live with tokenized stocks. Bitcoin's price is dead, range-bound for over a month, but the plumbing is being laid by the incumbents, the part that survives whatever Congress does with the Clarity Act. Plumbing beats price, medium conviction. Follow the money. The regime question this week is not, is artificial intelligence real? Taiwan Semiconductor settled that with a guidance raise. It is, who's forced to pay for the build-out, and does the market still reward the payers? And for now the answer is no. Watch where the structural money moved, out of the capital spending-heavy infrastructure complex. Semiconductors had their worst week since the tariff shock. The Philadelphia Semiconductor Index now sits about 19% below its June record, and Nvidia, the purest proxy for the build-out, fell and lost the crown. And into the capital return, low-spending names. Apple up 22% this year, retaking number one, and the defensive staples, Coca-Cola, Pepsi, and Procter & Gamble, catching a bid that Jim Cramer publicly likened to the third week of April 2000. Whether that dot-com analogy is right is the whole debate. Underneath it, rates and commodities are pulling the other way from the equity fear. The 10-year backed up toward 4.6% on oil, and gold, as we said, slipped below 4,000 even with a war headline, because a supply-driven oil spike reads as more inflation, not less. One more macro thread, because it's what's actually moving rates. The geopolitical tape got hotter. Fresh United States strikes on Iran and a Gulf escalation that hit Kuwaiti power and water infrastructure bid oil back toward recent highs, with Brent crude near $85. That's the reason the 10-year yield is near a 2-month high, and it's the reason we keep flagging gold. On a genuine war headline, the classic safe haven fell. The market is treating this as an inflation impulse, more reason for the Federal Reserve to stay patient, not as a flight to safety. So the swing variable for the whole disinflation trade right now is not a data release. It's the Strait of Hormuz. Contested but flowing is priced. A real closure is not. Watch Brent above 86 as the line where the inflation trade has to be repriced in earnest. A word on sentiment and positioning, because it's the mirror image of the data. Our market and social sentiment monitoring shows the commentary crowded almost entirely onto one story this week. The artificial intelligence bubble popped. Rotate to safety. It's April 2000 all over again. What that consensus skipped is telling. Almost none of it sat with the fact that the company at the dead center of artificial intelligence just told you demand is accelerating and got sold anyway. Almost none of it noticed that the big technology names people are calling the bubble have actually lagged all year. And almost none of it noticed the smartest market maker on Wall Street quietly buying a crypto exchange on the same de-risking day. When positioning is this one-sided and the details cut the other way, the details usually win eventually. Here's the single most revealing data point of the day. Apple, which spends the least on artificial intelligence of any megacap, just became worth more than Nvidia, the company the entire build-out physically runs through. Apple is up about 22% this year. Nvidia is up just 7%. For 2 years, the market paid a premium for optionality, for the biggest bets, the heaviest spending, the most compute. Today it paid a premium for certainty, buybacks, margins, and a company that doesn't have to spend $60 billion a year just to stay in the game. That flip, not the Iran headline flashing over it, is the most important thing that happened this week. When the market stops rewarding the spenders and starts rewarding the returners, it's telling you the trade has entered a later, more discriminating inning. Sectors in play, 3 of them. First, semiconductors, and this is a split, not a crash. The scale leaders, Taiwan Semiconductor and Nvidia, have the technology lead and the balance sheet to absorb higher spending and outrun a cheaper rival. The commodity tier, the memory makers like Micron and SK Hynix, does not, and now faces both a low-cost Chinese entrant and a market that simply stopped paying up for capital spending. The index, down 19% off its high, is the group repricing cost and competition, not demand. Second, consumer staples, the defensive bid. Coca-Cola, Pepsi, and Procter & Gamble catching the rotation flow. The bull case is genuine earnings durability. The bear case is that if this really is April 2000, staples are a symptom of the unwind, not a safe harbor, and they fall too. Third, crypto rails, structurally bullish and price agnostic. Citadel, Visa, and the Depository Trust Company all stepping in this week. The plumbing gets laid whether or not the Clarity Act passes. On the radar, 5 things worth your attention. First and biggest, next week's big technology second quarter earnings. Microsoft, Alphabet, Meta, and Amazon. This is the monetization versus spending verdict. Do the artificial intelligence monetizers actually convert their spending into revenue? That single question decides whether this rotation extends or reverses. Second, by August 8th, the Clarity Act floor push. It needs 60 votes, which means at least 7 Democrats, and the text dropped Thursday with none aboard. The recess is the hard deadline. Third, early next week, the Starship reattempt after Thursday's scrub, and how the newly public SpaceX stock trades below its offering price. Fourth, ongoing, the semiconductors. Does the group find a floor here, or does the unwind broaden into the rest of megacap technology? and fifth, oil in the 10-year, where the Gulf escalation is the swing factor for rates and for the disinflation story. The scorecard, where we grade the dated calls, including the ones that go against us. 3 new calls go on the record today. 1. The Apple over Nvidia crossover is a rotation signal, not a demand verdict. Over the next month, the spending-heavy complex, Nvidia and the scale chipmakers, stabilizes or splits rather than entering a sustained, demand-driven bear. That's falsified if semis keep making lower lows into August on genuine demand news. Cancelled orders and cut guidance, not just valuation. 2. The big technology monetizers hold up into next week's prints. At least 2 of Alphabet, Meta, and Amazon beat, and the artificial intelligence capital never converts story gets challenged, not confirmed. Falsified if 2 or more miss or guide down on monetization. 3. The crypto rails institutionalization trade decouples from the regulatory calendar. Citadel, Visa, and the depository trust company keep building regardless of whether the Clarity Act passes before recess. Now the carry-forwards. Our call from yesterday that the artificial intelligence hardware complex bifurcates rather than collapses is tracking well. The split widened this week into an outright change of leadership, and our call that Brent doesn't sustainably hold above $80 is under pressure at 85. The most expensive habit in markets is mistaking a price move for the news that caused it. This week the news was loud, a crown changing hands, a chip rout, an oil shock, and the crowd wrote the obvious headline, "Artificial intelligence is over." But the company at the very center of it just told you demand is accelerating and the market sold it anyway. That's not a verdict on the technology. It's a verdict on who has to pay for it, and, for the first time in 2 years, a market that would rather own the company writing the smallest check. So here's the one to sit with. When the market stops rewarding the builders and starts rewarding the owners, is that the top of a bubble or just the moment a boom grows up? Today's focus goes deep on exactly that. The asymmetric signal. One contrarian read a day. Subscribe.